Hello, Leigh Adams here, Special Counsel, Owen Hodge Lawyers. Welcome to I'm Still Standing, a brief discussion on how you and your business can survive and thrive the 2020 coronavirus pandemic. I will be spending a few minutes talking about current director duties and asset protection, and also then looking at gift and loan back arrangements. Current director duties and asset protection. Well, way back in 1925, you were judged as a director on what you knew and what you did. Now, of course, you're judged on what you should have known and what you should have done. Quite a difference. Even as late as 1974, the director duties in Australia were described as not being very demanding. But of course, how things have changed since then. The first director duty I'd like to have a look at is the duty to act with reasonable care and diligence. This is in the Corporations Act. A director must exercise reasonable care and diligence in the performance of their duties. This extends to all the responsibilities and powers that are exercised by the director. There is an exception in relation to the business judgment rule. If you fully inform yourself of all the relevant circumstances and make a reasonable decision based on objective alternatives, and that decision ends up being wrong, then you're not liable for any loss suffered by the company. However, you need to bear in mind that pie in the sky decisions will always fail the test. A director has to act in good faith in the best interests of the company. That's another duty. The director must honestly hold the opinion that the decision is in the best interests of the company, and it must objectively be in the best interests of that company. Furthermore, a director has to exercise their powers for a proper purpose. What was the purpose of the decision? Why was it made? What is the dominant purpose? That's the critical purpose as far as the courts are concerned. The courts look at the dominant purpose. Smoke and mirror explanations aren't going to pass muster. Courts look at the substance of the transaction, not the form that it took. Further, a director has to avoid conflicts of interest and not improperly use their position. Now, the key words here are not improperly. You must not improperly use your position to gain an advantage or cause detriment to the corporation. So consider where the sole director, in a recent case, caused the company to borrow $2.5 million. Most of that money ended up in the self-managed super fund of the family of the director. The court said that the loan was manifestly imprudent because it placed the company in a difficult financial position, and it was for the director's benefit, not for the company's benefit. Who is a director anyway? In fact, a director includes any person acting as a director, whether or not they're actually recorded as a director with the asset records. It also includes any person in accordance with whose directions the other directors are accustomed to act. And this extends to the patriarch, the matriarch, the bankrupt brother, the older sister obsessed with having a low business profile, and of course others. As regards breach of duty of directors, the maximum fine was increased in 2019 and now exceeds over $1 million. Plus, of course, a director can be ordered to pay compensation to the company for the losses caused by the breach of duty. This brings us to insolvent trading. If a company incurs a debt and thereby becomes insolvent, when the director suspected that this might occur. Note the word suspected, not expected. Suspected is a lower threshold, something that puts you on inquiry without sufficient proof, a hunch if you like. That's the threshold. If the director should have had a hunch or did have a hunch that maybe incurring this debt or series of debts would cause the company to become insolvent, then the director can be held liable for the loss. And of course, not just liable for the loss, but there's possible penalties, disqualification from being a director, and in the worst cases, custodial sentences. There are defences to insolvent trading. They include that the director has to show that they expected, not suspected, but expected that the company was solvent at the time, and that a reasonable person in their position would also have expected that the company would be or was solvent at the time. Then, of course, you've got class actions against directors. These have skyrocketed since 2006 when the High Court gave them the rubber stamp. So class actions against directors, we read about them all the time in the media. They're very much on the rise. There are safe harbour provisions, which are a carve-out for insolvency liability. These were introduced in 2017 and there are no decided cases yet, but they go like this. If a director, when they began to suspect that the company would or was insolvent, then at that time the director begins to develop a course of action which is reasonably likely to lead to a better outcome than administration or liquidation, but the anticipated outcome does not materialise, then the insolvent trading provisions don't apply for the debts incurred during the period. There are also anti-phoenixing laws. They began on the 17th of February 2020, early this year, and Liam will be talking more about those. Directors also have to be wary of the ATO director penalty regime, which was introduced in 1993 and has undergone many changes since then. And there are some recent changes to that, which again, Liam will talk about in more detail. So the conclusion in relation to director duties is that the best way to avoid, as a director, any liability and to protect your personal assets if you are a director is to understand the laws imposing liability on directors. Early advice is essential. Talk to a lawyer who understands insolvency laws. Is the lawyer or your accountant a member of ARETA, the Australian Restructuring, Insolvency and Turnaround Association? Now I'd like to look at gift and loan back arrangements. These have been around for a very long time and they're very popular, but there is a lot to consider. Take Melissa, for example. She is an employee doctor. She bought a house jointly with her risk-free domestic partner, and she has a substantial share portfolio as well. She's been offered equity in her medical practice. What does she do? Does she transfer the house to her non-risk partner or maybe to a trust? Well, no. The CGT provisions, stamp duty in New South Wales certainly, and land tax in New South Wales all work against such a relatively simple outcome for Melissa. What she does is she sets up a discretionary trust and she avoids the proprietary interest argument in the Rickstar case by ensuring that she's not the sole director of the trustee company, she's not an appointor of the trust, and she is not a default beneficiary of the trust. She values her share portfolio and the house, and she gives her equity amount in those assets to the trust via a deed of gift, a legal document, deed of gift dated signed. The trust then lends back under a loan agreement, lends back the gifted amount that Melissa made to the trust. The trust lends this back to Melissa, and it takes a mortgage over the house and executes a GSA in relation to the share collateral registered on the Personal Property Securities Register.
Melissa is solvent at the time that she does this, so the intent to defeat creditors provisions as set out in Section 121 of the Bankruptcy Act are unlikely to apply.
Then fast forward 4 years, it's now 2024, Melissa's running along very happily with her medical practice and then gets sued for medical negligence. The clawback rules as to undervalued transactions and argument that maybe she put the assets into the trust for an undervalue, that won't apply because the Section 120 of the Bankruptcy Act has a 4-year extension period and no more. The trust is a secured creditor of Melissa's bankrupt estate and takes priority over all other unsecured creditors in her bankruptcy. Melissa hasn't had to pay any mortgage duty in relation to the mortgage over the house. That was abolished some years ago in New South Wales. The stamp duty on the trust was only $500, and her partner continues to own 50% of the family home, so the CGT main residence exemption continues to apply, and the principal place of residence for land tax purposes also continues to apply. However, Melissa has no protection at all if she and her domestic partner split up down the track. So Melissa has a lot of things that she needs to consider beyond what I've just mentioned. She also has to ensure that there is no notional set law clause in the trust deed, otherwise Melissa can't be a beneficiary at all. She has to ensure that the trustee company is not a foreign person, as understood by the Foreign Acquisition and Takeovers Act 1975. And she has to be aware of that, because if she is not aware of it, she could find that penal stamp duty applies to the acquisition of the property. Also, she can't be a shareholder of a corporate beneficiary of the trust if that corporate beneficiary has an unpaid present entitlement owing to it by the trust. So you can see that this is complicated, and you do need to get comprehensive legal advice. Melissa, again, also may want to wind back the arrangement should she want to satisfy the threshold requirements of the small business CGT concessions set out in Division 152 of the 97 Income Tax Assessment Act. So in summary, what has happened here is the effect of the transaction is that Melissa's share of the value of her home and her share investments are taken out of her hands and have been shifted into the trust. But if the trust is a connected entity or an affiliate of Melissa, then its assets are taken into account in determining the $6 million threshold under Division 152. So again, this issue of wanting to possibly wind down the transaction in years to come needs to be taken into account at the time it is entered into. One of the key questions in relation to this, which I'm always asked, is, do I need to pay cash? Does Melissa need to pay cash into the trust? And the answer is, it's preferable, but it's not mandatory. The High Court case in 2004, the Eccles Court case, made it clear that you can use a promissory note, and providing the documents are properly prepared by a lawyer and have all the hallmarks of reflecting an intention to enter into legal relations, the mere fact that cash is not used and the promissory note is used is okay, despite what many people may think could be a problem, in that using a promissory note can raise the argument that the whole transaction is a sham because the promissory note goes from Melissa to the trust and back again. The Eccles Court case says that that's okay if you're entering into legally enforceable documents properly prepared, signed, sealed and delivered, as they say, then there's no problem. What about the loan and mortgage documents? Should the loan be repayable on demand? Does this affect the application of the Limitation Act? How does the loan document affect the terms of a mortgage? Should the mortgage be a deed? What terms should the mortgage have? Should they reflect the terms of the loan agreement? What can be done to extend the limitation period beyond the typical 6-year period? Melissa may want this transaction to run for 30 years. The answer is, use a good lawyer, ask the questions, and the lawyer will be able to answer them. The only other thing to bear in mind in relation to gift and loan back arrangements is that the issue of transactions to avoid future creditors is always lurking, not very far from the surface. if there is one or more future creditors that Melissa particularly wants to avoid, and she may have an upcoming tax liability, as Mr. Cummins did in the 2006 High Court case, then this may be caught by Section 121 of the Bankruptcy Act. But it is okay to enter into this sort of arrangement if you have a general desire to avoid exposure to a potentially improvident or hazardous investment. And there's nobody who would deny that entering into an equity arrangement in any business, whether it's a medical profession, partnership, or any other type of business, could be described as potentially improvident or hazardous. Any business venture is. Or to generally conserve family property, as per the Williams case in the 1934 High Court decision. The only other comment that I would like to make in relation to gift and loan back arrangements is that in relation to family provision claims, a properly prepared gift and loan back arrangement transaction can also limit or in some cases prevent family provision claims by unwanted relatives. Thank you for listening.
Thank you, Lee, and thank you for the opportunity to speak with everybody today. My name is Liam Bailey. I'm a registered liquidator and trustee in bankruptcy and a partner at O'Brien Palmer. It's the opportunity to speak to you today about business survival and turnaround in the age of COVID-19. And at the risk of repeating the obvious, we are living in unprecedented times, but it's certainly not a time for complacency in dealing with one's business, in that the opportunity cost missed for not dealing proactively with the circumstances that one's business finds themselves in at the moment, it can be fairly extreme. I wanted to talk to you today about the government response to the COVID-19 crisis. Obviously, everyone would be aware that one of the first steps taken by the government in relation to safeguarding businesses from the impact of the economic shutdown caused by the response to the coronavirus crisis was to provide directors with what has been interpreted as an excuse or an indemnity against insolvent trading, and also to impose restrictions upon debt enforcement during this time. This then was followed by a fairly extensive government stimulus package, the crowning achievement of which is the government's JobKeeper program. As a result of these initiatives by the government, the practical impact has been is that directors have become somewhat complacent about the circumstances that they find their companies in. And it's important that directors understand exactly what is and isn't covered and what the potential consequences of the any misunderstandings in relation to these matters might actually be. The first of the issues that we need to really consider is the practical impact of the insolvent trading indemnity provisions provided by the government. And to do that, we need to ensure that we have an understanding of what insolvent trading is. First and foremost, insolvent trading is the provisions under the Corporations Act that makes a director personally liable for debts incurred by a company at a time when a director knew or ought to have known that their company was insolvent and unable to pay the debts of their company as and when they became due and payable. Now, we could run entire sessions on what compromises solvency and insolvency and when directors are liable and when they are not. But suffice to say, the amendments to the law as part of the government's response to the economic shutdown when providing this perceived indemnity sound a lot broader and a lot more certain than they will actually play out. The reasons being is this: the insolvent trading indemnity is designed to shield directors from the consequences of potentially trading whilst insolvent that are beyond their capacity to control as a result of the economic shutdown and the unprecedented circumstances presented by the COVID-19 crisis. Companies or directors who were insolvent prior to the commencement of the crisis will likely not be able to enjoy the protections of the indemnity provided by the government. Similarly, the government has been clear that these indemnity is designed to protect directors from the unforeseen and unforeseeable consequences of insolvent trading. It is not intended to cover the consequences of insolvent trading, which is undertaken or allowed to occur by a director who is reckless or dishonest in their intentions in allowing a company to trade whilst insolvent, or in their company trading whilst insolvent during these times. And what has been mooted by a number of lawyers and advisors is, if a director during the current crisis does not address the issue of solvency of their company, they find themselves at risk of being considered to be reckless as to the solvency of their company, and accordingly may not enjoy the protections provided by the government's indemnity. In addition to this, a director who is reckless as to the consequences of their company's insolvent trading, or allows their company to do so with dishonest intention, not only commits a civil breach for which they can have a financial penalty or a requirement to compensate their company for the damages caused by their breach of that duty, but it is also potentially a criminal offence, and one for which ASIC can seek prosecution of the directors and the imposition of criminal penalties or other sorts of regulatory penalties, including being banned as a director of companies for a period of 2 or 5 years. So what we can see very quickly is that the government's insolvent trading indemnity is not the cover or protection that it has been mooted to be. When directors are considering the issue of solvency, it is important to understand that solvency is based on the company's ability to pay the company's debts as and when they fall due and payable. It is apparent from this definition set out in the Corporations Act that a test of solvency is a cash flow test rather than a balance sheet or asset test. And so the ability or the provision, the company's balance sheet having an excess of assets over liabilities may not be sufficient to mount a defence to any claim of insolvency against a company. That is, if those assets are not readily convertible into liquid or cash in order that such debts can be paid, then they may not be relevant to an assessment of the company's solvency. Similarly, it is important to note that it is not only directors that can find themselves liable for insolvent trading. A holding company can be deemed to be liable for the insolvent trading of a subsidiary, particularly in circumstances where the director of the holding company knew or ought to have known that its subsidiary was trading whilst it was insolvent. In circumstances where the director of the holding entity is also the director of the subsidiary, this goes a long way to proving the liability for the holding company. And it is not clear under the government's exemptions or protections or indemnities provided in relation to insolvent trading, whether the insolvent trading provision as a liability to a holding entity will also be excluded on those grounds. There are a number of defences that are available, and the elements of proving those defences, once again, could be the subject of an entirely separate seminar. Suffice to say that it is important for a director to, as an essential element of any of the defences that they wish to apply, they may wish to claim, that they are aware of the solvency of their company, that they had reasonable grounds for assuming the solvency of their company, an essential element of which is up-to-date books and records and complete books and records of the company as the basis on which an assessment is made. The safe harbour defences that were enacted into legislation a number of years ago, again, potentially the subject of an entire seminar, are still relevant as protections for directors today, despite the government's proposed indemnity against insolvent trading. The safe harbour provisions are such that if a company recognises that a director of a company recognises that it is insolvent or likely to become so, obtains the necessary financial advice and implements a plan which is reasonably possible or reasonably likely to result in a better outcome to creditors than the immediate liquidation of a company, they can claim such provisions under the safe harbour as a defence against insolvent trading whilst implementing the strategy for a better outcome. And safe harbour advisory roles are being, directors are engaging safe harbour advisors regularly throughout the current period in order to avail themselves of these protections in the event that they are ultimately unsuccessful in saving their companies and find themselves answering as to their conduct before a liquidator. Extremely important to note that the government's response to the COVID-19 crisis, in which it was made clear that companies have a 6-month moratorium against, in order to have time to respond to statements of claim brought against them, is not in and of itself a cure-all to the financial woes of a company. Debts that were owing prior to the commencement of this relief period, or debts that are incurred during this period, will still be able to be enforced at the end of the period of the relief, which is roughly 3 months from today. And if companies find themselves in situations at the end of the period in which debts cannot be enforced without adequate assets or capital to meet the debts that will soon be brought against them, they're going to find themselves in very serious situations. So relying upon that moratorium against debt enforcement without making provisions to meet the debts at the end of the period is probably not a reasonable response from debt directors, or such could be considered to be a recklessness on behalf of directors in the way that they engage with their companies and their duties as directors. It perhaps should go without saying that at the end of the moratorium period, your creditors or the creditors of the company will have a high incentive to commence debt enforcement proceedings in that circumstances where they find themselves cash flow strapped themselves and facing the same financial pressures that every other director and every other company may be facing throughout the current crisis. In order to adequately discharge one's duties to the company and to preserve the businesses that they're running, it's important that directors have regard to the debts that may be enforced against them at the end of the moratorium period, and be ready to respond to debt demands and debt enforcement claims brought against the company at that time. Now, the third prong of the government's response that's relevant for our consideration is the government stimulus package, and the principal component being the JobKeeper program and payments that have been made to businesses in order to help preserve employment and preserve businesses throughout this period. It has been much spoken of that the extent of funding being provided to businesses has declined from an initial projection of 130 billion to about 65 to 70 billion. And so it's important that directors are not cavalier about relying upon government stimulus that may or may not be provided. If by this stage of our progress through the coronavirus response period, stimulus hasn't been received, directors should be in a position to be sure whether or not they are going to receive that stimulus, and whether or not they can rely upon it as a potential asset against which needs to be taken into account when assessing the solvency of a company. Directors who blindly rely upon a hope of future provision of stimulus package or JobKeeper payments or any of the other incentive programs provided by the government may not be considered to have acted reasonably in discharging their duties, and accordingly could be found liable for debts incurred. So then, what tips can I, as a liquidator, provide for you to assist your business survive the current crisis? Upon request, Brian Palmer has published tips for business survival during the coronavirus crisis that we make available for you at any time. However, these essential points can be extracted from that guide. The first is that directors need to be aware of the importance of making as accurate as possible cash flow forecasts for their business, and then monitoring the progress of their business against those forecasts. Cash flow forecast being the basis upon which a reasonable director can be said to satisfy the requirement that they have discharged their duty to prevent their companies from trading whilst insolvent. It probably goes without saying that businesses need to eliminate unnecessary expenditure during this time. And we have seen that a number of businesses, or most businesses, have to some degree sought to cut the expenses of their businesses, whether it be through a reduction in staffing levels, a reduction in marketing budgets, or any one of a number of initiatives designed to cut the expenses of a business during this time to ensure that the business has a reasonable expectation of paying the debts that it has incurred. It follows that another type of way of ensuring such is to increase or diversify revenue. And we have seen businesses come up with some very creative and interesting ways in which to increase the revenue of their businesses during the current time. Businesses sharing offices and subleasing their spaces. Businesses redirecting the marketing budgets of their businesses to target potential areas of revenue that are of particular interest to their clients during the current crisis. These sorts of arrangements are all things that need to be considered, and the benefits of documenting them as part of any defence that a director might wish to ultimately claim cannot be overstated. The benefit of communicating with your creditors can similarly not be overstated. If you are suffering financial difficulties in paying your debts, it's entirely likely that your creditors are suffering from similar financial pressures. The ability for you to communicate with them, to let them know that you are doing everything that you can to meet your responsibilities to pay debts that are owed, to provide them with some sort of timetable by which they can hope to receive payment from you, so that they can communicate with their own creditors and come up with similar arrangements is really important. In this regard, a little bit of empathy for the other people, our stakeholders and creditors and the people that we're dealing with is not only a good business practice in that these are the relationships that our businesses need to survive the crisis, but also might result in some much better results for you in attempting to negotiate repayment arrangements during the current times. Similarly, this communication should be extended to your customers. Your customers are having as much trouble paying you as you are paying your creditors. And so communication really is key in the current crisis to maintaining those relationships and bringing about the most beneficial results for everybody that can be achieved. A number of businesses have sold assets that are not being utilised during this time, or sought alternate arrangements by which assets can be sold and leased back in order to raise capital. Staffing arrangements have been considered by which staffing can be transferred to reduced rates and reduced hourly rates and reduced working time, part-time arrangements costing less and hopefully meeting the requirements of a business during this time. Many employees have found that they have to be accepting of such arrangements, or otherwise they may not have jobs to come back to when the current crisis passes. It's important to recognise also that there are a number of people out there at the moment who are offering what we consider to be risky financial arrangements. It's important to consider the terms of finance being provided to you. Is it the best possible rates? Are the securities that are being requested of you reasonable? And is the exposure that you're providing to your own personal circumstances worth the risk of obtaining the finance for the business at this time? Now, it cannot be overstated just how much of an industry has grown about the provision of vulture finance during the current crisis. And I cannot overstate enough how important it is to obtain proper professional advice from your accountants and lawyers before entering into such arrangements. These are also the people who may be able to provide you better alternatives than are currently being presented to you as an easy fix to the problem. This is all well and good, but it doesn't necessarily mean that these solutions in and of themselves are going to solve the financial issues facing your business. And so it's important to make sure through that you're obtaining the professional advice to deal with issues, it's important to understand what the potential risks are in getting this wrong, and the options that are available for dealing with some of these problems if they cannot be resolved in the more informal manner by some of the initiatives that we've discussed just now. As I said before, there's never been a more important time to communicate with your creditors, and the ATO of those is one of the most essential in which communication is key. The ATO at the moment has a mandate and reason to be reasonable in dealing with taxpayers as it seeks to recover monies owed to it, and compromise arrangements put to it which are reasonable and can be supported in the circumstances are being well considered by the ATO at this time. However, one of the major issues that's being presented is that the ATO is offering and approving repayment arrangements to directors, and directors need to be aware of the consequences of entering into such arrangements. It is a common misconception that entry into an ATO repayment arrangement defers the date on which a debt is due, and this is not correct. A repayment arrangement with the ATO is an agreement of forbearance against the ATO, by the ATO against enforcing debts against the company if you comply with the terms of that agreement. It does not change the definition of when a debt becomes due and payable, and in and of itself can be seen as an admission by the company of its insolvency by its inability to pay the debt or the requirement to enter into the repayment arrangements. The practical consequences of this can be minor or they can be severe. If the ATO repayment arrangement is complied with and the company comes out the other end, no harm is done. If, however, the company cannot comply with its ATO, with its repayment arrangements and is ultimately wound up, monies paid to the ATO in the 6 months prior to the commencement of the winding up can be recovered by a liquidator as a preferential payment. Where this becomes an even bigger problem is that it can be seen as an admission by the company of insolvency, and further debts incurred after that date can be claimed from the director under the insolvent trading provisions of the Corporations Act discussed further. Lastly, the ATO legislation provides that in circumstances where a liquidator recovers preferential payments from it, the ATO has the right to seek an indemnity from the directors of the company to recover monies that it has disgorged to repay the liquidator the preferential payments that it has received. The practical consequences of this are that the company may have paid the debt. The liquidator is required then to recover the debt for the benefit of the creditors of the company as a whole, and you as a director can find yourself being required to repay that debt out of your personal assets. Accordingly, it appears that the debt has been paid twice. So it's important that if entering into an ATO repayment arrangement is an option being considered to address the solvency of the company, that the commitments that the company is adopting under those arrangements are reasonable and can be complied with. Because failure to comply with the ATO repayment arrangement all the way through to resolution of the debt can have serious consequences, as can the inability to continue to pay current liabilities as they accrue throughout the period. So ATO repayment arrangements are not the cure-all for the company's woes that they might otherwise have thought to be. Similarly, it's important to note that the ATO has the power to issue director penalty notices that make the director of the company liable for debts incurred in respect of statutory debts. In particular, director penalty notices, again, a subject or topic that could be its entirely own seminar, but it is enough to directors for the purposes of this seminar to note that where a company owes debts to the ATO and has reported those debts in line with the statutory requirements to lodge with the ATO, then the ATO has the ability to issue that director with a notice, providing them 21 days within which they can seek to have the debt paid, enter into a repayment arrangement, or to appoint an external administrator to the company in order to prevent them becoming personally liable for those debts. However, the ATO can also issue what is called a lockdown director penalty notice in circumstances where the company has failed to lodge and report debts owed to the ATO for more than 3 months past the requirement of the reporting date. Then the director penalty notice issued by the ATO will not contain a 21-day provision for the director to take action to avoid liability. Instead, the personal liability of the director locks down and cannot be voided except unless paid. So not only is it important that the companies remain current with their payments to the ATO, but if they can't be, then it really is important that at the very least they've maintained proper books and records and reported adequately to the ATO of the debts to be incurred. Under recent legislation changes that have passed in March of 2020, the debts that can now be turned into director penalty notices and personal liabilities by the director also includes GST and any other BAS debts, as well as unpaid superannuation and unreported and unremitted PAYG. Any of the debts that a company can become liable for to the ATO can become personal debts of the director in circumstances where the company has failed to report to the ATO within the required time frame. And so therefore, it cannot be overstated once again the importance of communicating with the ATO and lodging your tax returns. Now more than ever, with the introduction of single touch payroll and data matching that the ATO employs, it is easier than ever for the ATO to detect when businesses and companies are trading in circumstances without reporting and what those liabilities might be. It's important to note that the ATO not only has the power to raise estimates of these liabilities against the company, but also then to push those estimates onto the directors under the director penalty notice regime. And once it has done so, the onus or burden of responsibility to prove what the actual liability is moves from the ATO to the director. And so the costs of defending against these types of debts and these types of personal claims can be rather severe. Lastly, it's important to note what formal options are available to directors through the business restructuring, advisory and insolvency industry. It's important for directors to be honest about the prospects that a business has, the merits of that business, whether or not it is important, whether or not a business is actually worth saving. Although this is an emotional subject in which directors are very heavily invested, it really can be in the best interest of directors to consider the merits of the businesses seeking to save dispassionately, as directors can expend significant personal capital saving businesses that either are too far encumbered to save or do not have good merits to save in that they aren't providing a worthwhile return to you as a director for the efforts being put into it and the money being expensed. As such, the first option that needs to be considered in compliance of a director's obligation to prevent a company trading whilst insolvent is the appointment of a liquidator and the winding up of the company's affairs. Similarly, however, if a business is to be saved, there are two main procedures to be put in place that might rehabilitate a business's circumstances. The first is the pre-pack. That is the legal phoenixing of one's business by having the transfer of its business to a related entity in order to remain under control. Now, there's been much discussion about phoenixing and a general disapproval of the process, but it's important to note that it is entirely possible to legally phoenix your business. The essential difference between a legal and fraudulent business phoenix transaction is the value for which the assets are transferred to the related entity. And it's important that if you are to engage in transferring one's business to a new company so that it can continue to trade, that the transaction appears to be at arm's length between the two companies. And that is that the transaction or sale of the business from the debt incumbent entity to a new entity occurs in much the same way as it would as if it was a sold at an arm's length transaction. The important steps are that the business is valued as a going concern, that there is a documented legal agreement for the transfer of the business to the related entity, and that entity that is acquiring the business pays valuable consideration based upon the valuation for the acquisition of those assets. Now, this is not necessarily a simple procedure, and one to which I recommend that you speak to a professional business advisor, lawyer, or accountant prior to embarking upon. However, similarly, another method for which a business can be saved is the voluntary administration regime. The voluntary administrator is appointed to a company which imposes a moratorium on the company's affairs in order that an administrator can make recommendations to the creditors for what is the best possible outcome for the future of the business, and whether a negotiated settlement can be recommended for creditors' acceptance in order to settle the company's liabilities, or otherwise whether it ought to proceed into liquidation so that the business can be further investigated by a liquidator, and a liquidator can potentially recover further assets for the benefit of creditors. This voluntary administration process does allow for a business to continue to trade and can be saved, but it is not necessarily always the cheapest or simplest of procedures to apply, particularly in circumstances where the company is not going to enjoy the support of a majority of its creditors, or in circumstances where there are non-transferable assets, such licenses or tender rights that need to be preserved. And so, once again, we cannot recommend or overstate the importance of obtaining proper professional advice. The Safe Harbour Advisory is important as a way in which directors can be provided with additional certainty against potential personal liability for the debts of a company, and insofar as a Safe Harbour Advisor can assist the company with the assessment of the company's solvency and the options available to it should a risk of insolvency or actual insolvency be identified. Please, if you do have further questions, whether in theory or specifically relating to the businesses over which you currently have guardianship or directorship, please don't hesitate to reach out to us here at O'Brien Palmer for a no fee and no obligation consultation of the circumstances of your company and the options available. Speak to your accountants, speak to your lawyers, speak to your business advisors, as their experience is an incredibly valuable asset during the current crisis. And for further information, please don't hesitate to have a look at the information available on the O'Brien Palmer website, www.obp.com.au. Thank you very much for your time. Again, my name is Liam Bailey, a partner of O'Brien Palmer, and I hope you have a great day.